Hello traders everywhere, Adam Hewison here, co-founder of MarketClub with your 1 p.m. market update for Friday the 21st of October. So here it is, another week in another choppy market to speak of. If you look at the last several days in the S&P 500, we've not closed 2 days in a row in the same direction, which is very, very unusual. Obviously the problems in Europe continue to be maybe solved, possibly solved, could be solved. We don't quite know. But what I want to talk today about is how to avoid what we call Slice-O-Matic markets. These are markets that really don't have any real strong direction. And this is one of the biggest challenges for many traders, is avoiding whipsaw markets. It's a market that lacks direction. We sometimes call these Slice-O-Matic markets, as I mentioned, and they really cut your equity into smaller chunks if you're not careful. You only have to look at the S&P, as I mentioned earlier, to see what has happened. But so how do you avoid these markets? One of the simplest, easiest ways I know is to use our trade triangle technology. And I'm going to explain that today to you, how we can do that. So let's go to our first market, which is the S&P 500. And we're clicking on the chart. And you can see we obviously have an up day today, which will be only the second day we've actually had an up day. If you look going back here, you can see this was a up day, down day, up day, down day, up day, down day, up day. So this is pretty unusual. Now the question is, if you look at our trade triangles, we have our long-term monthly trade triangle from 1258.07 is negative. Our short-term, intermediate-term triangle of 1,220.39 is basically in an up mode. So when you have these two markets like here, and let me put my telestrator on, when you have two markets that are conflicting, like here and here, it puts you in a neutral position, which avoids the Slice-O-Matic market. Okay, so here we use our monthly. That's for long-term trends. Okay, and that's for direction. This gives us our direction. So I'm going to say just put direction underneath here. So we use the monthly for direction. This is in equity markets now. It's different from the futures or Forex markets. Long-term trade triangle for direction. Intermediate term triangle, which is right here, for timing. Okay? So if you look at the conflict here with the short term, or the intermediate term, I'm going to call it, the intermediate weekly triangle green and pointing up, and the monthly pointing down, it gives you that conflict, which means you are in a trading range, or you should be out of the market. In this case, if you're an intermediate term trader, you should be in a neutral position. You would have taken your position, you would have gotten out of your position, and you'd simply be on the sidelines waiting for another red triangle should it occur. So this would turn red. This particular indicator turns red. The weekly trade triangle turns red, and that would give you a chance to get back in and go short. However, right now you can see the triangles right here at 1220.39, so the market's trading at 1232.96. That's pretty good. We're also, if you look at this on a trading viewpoint, this is our trade triangles we're talking about, but if you look upon strictly a trading viewpoint, we're kind of at the top of this level here. We did get a pop-up, obviously, but this is all to do with, is Europe going to be good? Is it bad? Is the summit going to be on? Are they going to agree on anything? And this is still a kind of like Europe's wagging the dog here. We've had some good earnings out of McDonald's and some other companies that are doing very well, but nonetheless, you really want to be very, very careful in these markets. These are what we call Slice-O-Matic markets. So let's go to our next market to clear everything off the screen. And we're going to go to the silver market, and that's going to be the spot silver, which we track every day. And you can see right here on the spot silver market, all of our trade triangles are red. Now what this means very clearly is that you have a very, very strong downward trend, or what they would call a bear market. Now a bear market is called a bear market simply because it pushes you down. It claws you. It jumps on top of you and sort of pulls you down. So we've talked about this before. You had the move down like here. You've had the sort of recovery and turnaround like right here, similar to this, but on a more exaggerated scale. Okay, so generally speaking, the trend right now, it looks as though we closed last week somewhere around these levels, around 32. We're currently trading at 30.96. Not a big move on the upside, loss on the downside, but certainly it was a loss so far for the week, unless this market has a miraculous rally later in the week. So let me just clear this off the table for a second, clear the screen, and look at our weekly charts. And it's quite easy to do with MarketClub. Just go up here and you click weekly, boom, and you can see there right away you have that red weekly triangle, which is not a positive sign for this market. And as you may not know, we actually have real-time prices for spot metals, both silver, copper, and gold. And if we pull this down, you can see that this market is a little bit overbought, but really no strong feeling there for the moment. And I think that let's go to our next market. But generally speaking, we've sort of gone sideways here. Really no strong trend, but sometimes these markets just can erode, and then they start to accelerate. Here's a good example. The market sort of started to erode here, negative week, and then suddenly, boom, and you get 4 negative weeks in a row. We could very easily fall into this level. We'll have to see how that plays out in the marketplace. So let's go to our next market. And this is going to be gold. And by the way, I'm coming back this weekend to do a weekend wrap, which you can hear right on this channel. And you can see basically we're plus 55. Now that's a trading range for the most part, but we've got both of our weekly right here and our monthly in positive modes, indicating that the longer term trend is still positive for this market. So intermediate term traders and longer term traders should be long this market. If you're a very short-term trader, you should just be out of the market because we have a conflicting signal with the weekly and the daily. So again, this market sort of flattening out, no strong trend, sort of just below the midpoint of the Donchian trade channel. We're not really oversold yet, and that's a pretty interesting thing to look at. So let's turn this into a daily chart, and you can see the action so far is pretty much the same. We've got the Donchian trade channels, as you can see, are tightening up dramatically, and we are eventually going to have a move out of this market one way or the other, and we want to be able to capitalize on that when it occurs. So let's go to our next market, and the next market we're looking at is crude oil. Crude oil has had a very it's been the market without a brain, in the sense it just follows pretty much let me just take this off. It follows pretty much what the equity markets were doing. And look at this. You've had red, blue, red, blue, red, red, blue, red, red. Very little pattern in this. Sort of, if you look at this market, it's sort of really sort of gone sideways for a good part of the last several months anyway. If you look at this resistance, we talked about this resistance right around here, which is right around the 90 level. And that's been enough to curtail this market. We had a little jaunt up there on Wednesday, failed to get there. The market isn't really so excited about pushing this market higher. And I think for the most part, we may see this market sort of roll over to the downside. Now, a lot's going to happen with the equity markets, and that's kind of like a crapshoot. But we're minus 55, indicating a trading range. Longer term, the trend is down. Intermediate term is mixed. So you should really, if you want to be conservative, be on the sidelines in this market. And really, you have to understand you have all year to trade. You don't have to trade every single day, and you don't have to be in the market every single day. Sometimes being in a cash position is not a bad thing to be. And I tell folks all the time, you don't have to be in the markets all the time, and frankly, sometimes it pays not to be in the markets when they're very, very non-trending. The recent article I did on MarketClub, but basically the premise is really, in a move, you want to get this part of the move, what we call that the fat part. Now, you're never going to buy the bottom, and you're never going to sell the top. And no one in the history of trading does that on a regular basis. They may do it once in a while, and if they do that, they're kind of lucky. But it's certainly not something you can count on doing in any kind of program or system. It just doesn't exist. And I've seen everything pretty much in this industry, how it works and comes and goes. Now, what you can do sometimes is you'll see a market move out of the channel right here, the Donchian trade channel, and then it moves back in. Now, but you're not going to buy the bottom. I mean, it just doesn't happen. I mean, you'd want to see some sort of maybe some move over resistance, and boom, you've got a better idea that the market has turned around. So let's clear everything off the screen and go to our next market. And now the next market's an interesting market because it's the dollar index, and the dollar index has really taken a hit here in just the last couple of days. Now, look at the move. We had a move that went from, let's say, August 28th, and let me just get my telestrator on, from around this level here. This is if we look at just the low in this market, around this time period, just outside of the Donchian trade channel, moving all the way up here, which is a significant move. Now, we did not catch the bottom and we didn't catch the top, but we did catch a nice part in the middle, which is around 76.60, and the market took off to 79, almost 80, which we were targeting. Now we're back to 76.42, which is really back to where this level is, and nothing has changed. The longer term still is positive, and the weekly here is conflicting with this longer term trend that is green. Okay, so what would you do? The best thing to do, the most conservative thing to do at this point in time, is just wait until this weekly, until it turns green, and if it does that, then you know what to do. And if the monthly, meaning here, if this turns red, then that's your entry point. We have the rules right on our blog today. So if you want to see how to use the trade triangles successfully in MarketClub, this is what you really want to take a look at. So let's take this off the screen and go to our next market. And the next market we're looking at is going to be our inflation indicator, and that's going to be the Reuters-Jeffries CRB index. And it's a very important thing to watch because it really does reflect lots of things. One, it reflects the price of crude oil and many other raw materials. And you can see that we have, let me just take this off. We talked about the pullback here. We drew this in last time. And you can see we go back to our 50% retracement. Then we had a little pop. But generally speaking, the market is still in a negative mode longer term. The only green triangle we have is an intermediate triangle at 317.40. Now that's pretty close to the high, but nonetheless the monthly is short from 335.10. So if you're a long-term trader, you can just use, you'll be a super long-term trader, just use the monthly trade triangles. If you want to be more of a trading trader, just use the monthly and the weekly in conjunction. It's very, very powerful. And if you're a very short-term trader, you want to use the weekly and the daily in conjunction. Okay, so here we are. It looks to me like we're probably going to close the week out on a low, unchanged, or a little bit lower for the week, and we could do that quite quickly. Is looking at the weekly here, and you can see it's down for the week, and we're down about 1.7% for the week. And it looks as though we are maybe closing down towards those levels. I would not be surprised to see a little more pressure coming into this market. And next week, of course, is going to be all news about Europe and what's going on there. So just to recap with you, when you go to the portfolio manager, you have a quick score about what the trends are. Obviously, if you're looking at, this is not one that we're talking about, so we can take that off. But generally speaking, you can see how these markets work. And if it's a 55, it tends to be a trading range. And you can see we've got 4 out of the 6 markets in a trading range. We have a very strong downtrend in silver. And in the S&P 500, on a weekly basis, we are higher. It'll be the 3rd week in a row we've actually traded higher in this market. But it still isn't clear that we've got this thing rip-roaring to the upside. So I'd be a little bit careful about following any long positions this weekend. Unless it's one of our 52-week high rule, which we'll talk about probably on tomorrow, on Saturday. So, hey, I'll be back on Saturday with an update, weekly wrap. Thank you so much. If you haven't tried our one-on-one MarketClub personal coaching, you may want to take a look at that. I think it's very, very useful. It's the end of the week, and I think you may want to give that number a call. Give our number a call here. But, I think you really want to ask yourself, can personal coaching help my trading? I believe it can. So give us a call today. It's 877-219-1482. And it's a free call. It's a free consultation. You have nothing to lose on that. So give it a call today and see how that could help you. So I'm Adam Hewison for Market Club. I'll be back on Saturday with a weekend wrap. Have a great weekend.